Good day, students. Welcome to another video of Gen Z Tutors. We will be discussing the accounting cycle or process. This is your tutor, KT Majol, umchulu, macingwane, weyes, uphakathi, umqulungu, wena wasengunyameni. Phakathi akagugu kuyozoguga iy'ngane zakhe. Mabuya ngomthongwane, abafukazi babuya ngamahlahla. Nyukani kuhlaza, mabona bulawe, ndlela zabadluli nabagodusi. Jama kasilwane, ndaba ezitha. Now let's get to it, guys. So now we'll be talking about the accounting cycle, and what you have to remember about that accounting cycle is that number one, you will be dealing with the source documents. That's where all transaction will be coming from. Then from the source documents, you shall create what you shall start classifying your particular transaction and classify them either their assets, income, or liabilities, or owner's equity. You understand, and expense and stuff like that. Then thirdly, what will you do? You will generalize everything. And then from there, after generalizing everything, you will go and create your your ledgers. Then after doing your ledgers, you do the thingy, trial balance, which is gonna be the unadjusted trial balance. Then from there you will go and continue to do your adjustments to trial balance. Then after that you prepare your adjusted trial balance. Then from there you go and say, okay, fine, you're gonna prepare your adjusted trial balance. Over here it's your adjustments to trial balance, actually. Adjustments to trial balance, and then you prepare your adjusted trial balance. Then from preparing your adjusted trial balance, it's your closing off process. And then after your closing off process, which is number 9, then that's when you do what you call prepare financial statements. Prepare your financial statements, which will be your SPL, statement of profit and loss, or statement of financial performance. And then you have your statement of financial position. Then you'll have your statement of changes in equity, and then you'll have your statement of cash flows, right? And then that's where you go, and then you are done. After that, you prepare your opening trial balance for the new year. And then you're complete with your accounting cycle after that, right? And then now on this particular video, what are we gonna go and prepare? You're going to go and prepare the journals, the ledgers. That's all we're gonna cover for this video, and then the rest of the information will be covered on other videos also as well. And then but we will use the same information all throughout this whole course, so that you guys can actually grasp everything and know that everything is interlinked and it's integrated. Instead of you looking at the questions as if they are separate questions, I want you to look at everything as the same thing. It's part of one of the same system that's happening. So we'll just generalize and do ledgers, and then on the next videos we'll prepare the unadjusted trial balance, then adjust the trial balance, and then we have the adjusted we'll have the adjusted trial balance. Okay, I think I repeated that over here, that's fine. And then let's just do that. Okay, and then the numbering will change, it's fine. Then we'll have the adjusted trial balance. That will be on the next video, and then the video following that, the closing off process will be covered in this video as well. Then after that, we'll prepare the financial statements, right? I hope we are all still together. So this is what we'll prepare on this video: the journals, the ledgers, and the closing off process. And then afterwards, the next video will be covering the trial balance, right? Okay, fine. So now with the previous information that we had from the previous video of the accounting equation, what did we have? We had the owners which contributed 100,000 to start the company, took a loan of 100,000 payable in equal installments at year end for 8 years. Then we paid BZ agency for assisting in creating the company for 5,000 with 5,000. Then we purchased two motorbikes at the start of the company and depreciated, which is depreciated on a straight line method for 5 years. And we purchased another motorbike halfway through the year. All these motorbikes were purchased for 50,000, and then you have that in mind. Then the owner took 10,000 for personal use, and then the monthly rent is 3,000 every month. Then we completed 544 deliveries for the year with an average revenue of 100 rand per delivery with 60 rand fuel cost average, right? So now let's go and start with the first transaction, which we actually already did here. It's just that we are using the accounting equation, but this time around we'll be using the channels, and then we won't use CRJ or CPJ sales channel. We'll just go into the general channel. So let's just say general channel. And since you do note that we did not include dates over here and stuff like that, except for the date of the beginning of the year when the company was created to the end. And then the other transactions, it's fine. Since we did not use the dates, it's fine. We'll just continue as normal. So now, even though the format should be date, then details, and then folio, and then we'll have our debit, and then our credit over here, right? Then we are fine. Then from this particular situation, what we have, the owners contributed 100,000 to start the company. So those in that situation, we affected two parts of the accounting equation. We're affecting the asset and the owner's equity. So now what are you gonna do? You're always gonna start with the assets, and this was happening on where? On April 20x2, right? And then what we have, we had bank, which goes to the SFP, and then we are done with that. And then the folio, it's fine. Even if you just say transaction number one at this particular point in time, that's fine. This was for what? 100,000. And then what else do we also have? We had shareholders contributions, which are an owner's equity and have a credit balance. So now we have shareholders contribution, shareholders contribution, which start where? On the statement of changes in equity. And also again, I want you to take note of one particular item. The reason why we use statement of changes in equity, as much as shareholders contribution appear on the statement of financial position, but when we are preparing the documents, they first appear where? On the statement of changes in equity before they appear on the statement of financial position. So we are looking at things in order of how they appear. Understand? So always keep that in mind. This is the very same reason why whenever we have an income or an expense, we will always say it goes to the statement of profit and loss, even though we know it will be posted afterwards as profit for the year into what? Statement of changes in equity and affect the retained earnings. And from affecting the retained earnings in the statement of changes in equity, they will go afterwards. The retained earnings will appear where? On the statement of financial position. But where did that income and expense first appear? It appeared where? On the statement of profit and loss. So keep that in mind so that you make your process of knowing where, on which statement does the item that you are dealing with or transaction you are dealing with actually appear on. So just look at where does it first appear. You understand? Then you should be fine after that. And then since we're doing our journals over here, to make things easier and faster for us and for us to not forget anything, let's just do this immediately at the very same time. Since we've created a bank transaction, let's go and prepare what you call, let's go and prepare a bank ledger. So we're gonna go and say bank. Then from preparing bank, you can go and say can say our bank account opening balance carried down. What did we have? We had nothing at the beginning of the year. And then now what are we going to do? We're going to say we had a debit. So on the debit side of bank, we had a debit. On the debit side of bank, debit 100,000, right? And then from there, we're gonna say, why did we debit 100,000? It is due to shareholders contribution, right? Shareholders contribution, we did that. And then after that, what are we also going to do? We're gonna come in the side and say we're gonna create a shareholders contribution ledger. We're gonna create a shareholders contribution ledger. It's contribution. Shareholders contribution ledger. And then on creating the shareholders contribution ledger, what shall we have? We shall have the beginning of the year, which we had the opening, which with the opening balance carried down, it's fine, even if I didn't write the full thing. And then we had what? We had nothing at this point in time. And then what else happened? We go into our journal. This is how you should always process. You're saying, okay, you're gonna open a ledger of shareholders contribution. We had a credit of 100,000. You go and say you had a credit of 100,000. Put in that 100,000 credit. And then why did we have that credit of 100,000? It is because of what? Of bank, which is here. I'm just gonna use this. You understand? And then it is because of bank. And then we are sorted, and then the debit and credit is still balanced at this point in time. And then from here, what are we going to go and do? Then look at the next transaction. We took a loan of 100,000, which is payable in equal installments at year end for 8 years. Now take into account that this is currently we are at the end of the year, right? We took the loan at the beginning of the year. That's fine, and the loan is going to be paid on yearly installments, which are going to be equal for 8 years, right? So now I want you guys to take note, Tuguti. What we're going to do now, we're going to say, fine, we received money in our bank account, right? We received money in our bank account, SFP. Close that in there. And then say, okay, fine, we received 100,000 on our bank account, and this was due to what? Loan capital. Loan capital, right? And then this goes into SFP. That's where it will first appear. Then we put that in there. Then now, before we go any further, let's go and create the loan capital ledger account. Right, and then let's see, let's just put it here. Let's just put it this side, okay? Have what? Loan capital. Have loan capital over here. Then by having loan capital, what else do we have? Let's just prepare this quickly. Then from having loan capital, it's gonna be what? We're gonna say on loan capital ledger, we're gonna credit 100,000 to bank. So now we go and say, fine, put in that 100,000, that credit 100,000, and this is due to what? Due to bank. And then we put that in there. And then on our bank account also again, we're gonna go and say, fine, debit 100,000 on bank due to loan capital. And then you say 100,000. We put in 100,000 over here, and then say this is due to what? The loan capital, right? So we received the money, everything is still balanced, everything is fine. And then also again, you have to take into account, for every transaction that we have, especially when regarding to loan, if ever we have a loan and we're gonna be paying it within 12 months, what do? We prepare, since remember loan is a non-current liability, so now we need to prepare the current liability, which is going to be occurring within the next 12 months, right? So now at the beginning after getting the loan, what did we actually also do? We created what you call we said We want to move a portion of the loan, capital. Just say this. Want to move a portion of the loan capital. For how much? We're gonna be paying every year. We're gonna be paying what you call for the remaining 8 years, 12,500 every year. 12,500 every year for 8 years to pay out the loan, right? But now we are just moving this. Now we are reducing our loan amount that we owe by what? 12,500. Then saying now we are realizing any loan capital and get but you're gonna have loan capital and reducing it, and then we're realizing our current liability, which is gonna be what? Loan repayment, which is the portion of the loan that we are going to pay this year, right? Loan repayment. This is gonna go into what? SFP. Then you cover that up. Then you go and say credit that loan repayment, and then immediately you can go also at the very same time and just say fine, let's go and create a ledger for what? Loan repayment, right? And then you say here you can have loan repayment. This is a non-current liability. This is a current liability, I mean, you understand? So now also I want you to take into account this is for what? For this year. Recognition of current year repayment. Right. And then also again, I want you to take note of it, since it's gonna be within the next 12 months, well, which is now currently the current situation whereby we're actually having to repay the loan, right? Now, I want you to also consider that now, since it's year end, we're gonna have another loan repayment portion, current liability portion, which we have to pay next year within the next 12 months. So now we're gonna double this transaction again and say we're gonna have a loan capital, reduce our loan capital, SFP, and then from there we're gonna say fine, since you said it's gonna be equal monthly equal yearly installments, it's gonna be the same amount over here. And then even here we're gonna still say loan repayment again. Okay, it's shorting that up, loan repayment, then it's gonna be this 12,500, right? Loan repayment, it's gonna be this 12,500. Then we are good to go. And then from there, loan portion recognition, this on the what you call narration, you're gonna say recognition of next year loan repayment. You understand? Next year loan repayment. And then after that, we are not yet done. The next transaction we need to account for is that we're gonna have an assumption that we actually paid this year's loan payment and stuff like that, and then we will continue from that, right? So now whenever the year ends, now we are paying the loan, and then we're going to go and say bank SFP, and then we're going to say we are paying, oh sorry about that, we're going to go and say okay fine, we are gonna pay our loan, right? Whenever we're paying, we need to debit credit bank actually. And then we're just going to go and say loan repayment over here. Gonna go and say loan repayment, and then on the loan repayment, how much of the loan are we paying actually? We're gonna be paying what you call 12,500 for the year, right? And then once we've paid that, you're gonna go and say bank SFP and credit our 12,500 again, right? I hope everybody's still with me at this particular point in time. So now let's go and fill this in on the ledgers. right? Then now we're gonna go and say on loan repayment, this is still a liability. It's just that now at this point we're just creating the portion of the loan that we're going to be paying within 12 months or the current year, right? So now this is how everything happened. We received the loan, it is recorded, and then we said loan capital, we are debiting loan capital, right? Now we go and say, fine, we have loan capital, so now we're going to be debiting loan capital because of what? Of loan repayment, right? So now we're going to say we're debiting loan capital because of what? Because of loan repayment. And how much is that for? It's for 12,000. So we're reducing our what? Non-current liability, and now at the very same time we're increasing our what? Our current liabilities. So now we're going to go to the credit side. This thing had an opening, which was an opening balance, which was what? 0 at this point in time. And then after that, what did we have? We had a credit on loan repayment due to loan capital. So now it's due to loan capital. We put that in there, and it was a what? A debit, a credit of what? 12,500. This is the loan portion that we are going to pay this year. Let me just make it red so that you guys don't get lost. Let's just make it red. And then after this loan capital, what are we going to do? Again, even before the payment or after the payment, that's fine, whichever. It's just that we didn't enter the date. Then again, we're gonna recognize the loan capital portion that we are removing again for the next year, which is gonna be similarly the same transaction. Gonna have loan repayment over here, and it's gonna be due to how much? 12,500. And then from there, again, we come again. We're gonna go and say loan capital, and say it is how much? Uh, 12,500, right? So this other one, it's the black one, the other one is the red one. And then let me just make sure I make this one red as well, so that we are all together. And then we are good when we are like that. And then from this particular point in time, okay, this cells merged. Then now at this point in time, we are good to go, right? We shall leave this as it is, like this. And then from here, what are we going to say? And then afterwards, after we actually recognize the current liability of the loan for next year, we're going to go and say we have to repay our loan. So now when we're going to repay our loan, we're gonna go and say we are repaying our loan. We have a debit on our loan repayment of 12,500, right? Of 12,500 due to what? Due to bank. So now you go and say we are inserting our bank over here. And then on the bank also at the very same time, we're gonna go and say we're gonna credit our bank due to loan repayment for how much? For this 12,500, or you can just take it from here, up to you how where you take it from, right? And then at that point in time, we are fine. And then we are done with the loan. And then we continue with our transactions. We go and find out that and also again, the fact that the loan repayment is in the SFP. Take note that in this situation, we did not incur any interest. We did not incur interest on the loan. If ever we had interest on the loan, the interest on the loan appears on the thingy, especially its payment, it appears on the thingy, on the statement of profit and loss. If ever there was any interest, but we just add that transaction as the adjusting entries when we're doing the adjusted trial balance and stuff like that. So you should be fine. And then what else do we have over here? And then the next transaction that we actually have is we paid PZ agency for assisting in creating the company 5,000, even though we just made that another transaction later on, even though it's supposed to be at the beginning of the year. So we paid what? Startup cost. This goes into where? Profit and loss. Okay, let's just say PL, profit and loss, or SPL. This goes into SPL as an expense, right? For what? For 5,000. Then And since it was an expense for 5,000, it was paid for by cash, and this is by bank, which goes into SFP. And then we say we have this over here. And then again, at the very same time, we go immediately. Let me just do this. And then immediately you go and create what? Your ledger over here for what? Startup costs. Startup costs. So now you've created your ledger for what? Startup cost. Then you're good to go. And then from there, there you go. Okay, fine. Then since you have your startup cost, the startup cost will be what? Will be debiting startup cost for 5,000. 5,000 due to what? Due to bank, right? So now this is due to bank. And then on bank, we're gonna go and credit bank due to startup cost, right? So now you're gonna go in here and say startup costs, and then say for how much? For 5,000. Then we are good to go. And then you leave that like that. After that, what do we do? What other transaction we had? We purchased 2 motorbikes at the start of the company, and which are depreciated on a straight line method for 5 years. And then we purchased another motorbike halfway through the year. All motorbikes were purchased for 50,000 each. All right, fine. And then now what do we do to account for that particular transaction? You can just make it and sum it up into one single transaction and say motorbikes, motorbikes, motorbikes SFP, since it was an asset for the company to complete its deliveries. And then you're gonna have to go and say, okay, fine, all these motorbikes are what? We purchased 3 motorbikes throughout the year. Oh, actually, you can even just say we purchased 2 motorbikes at the beginning of the year, multiplied by 50,000, right? And then from there, what are you going to say? It's 100,000. And then you also purchased another motorbike. SFP, yes. For how much? For 50,000. This one wasn't the individual one, right? And then all of this, the money that came out of the company, it's how much? In total, the money that came out of the company is for how much? The sum of these two, right? Which is 150,000 at this point in time, right? And we have to consider that we've excluded VAT calculations on this, and let's just say we haven't started paying VAT yet, right? We are not yet a VAT vendor, so let's continue with that. Then from here, since you've already accounted for the motorbikes, then you should just immediately go into what? Your depreciation. And before you go into depreciation, let's complete the ledgers for the motorbikes also as well at the side. Then let's say, yeah, let me just say, okay, it's fine. Even if you put it here, it's fine. Then create a ledger for motorbikes. Well, I should have just done this as, okay, it's fine. I'll just do it next time. Motorbikes. And then motorbikes are an asset. Since they are an asset, what do we do with them? They have a debit balance, and the opening balance carried down was how much at the beginning of the year. There was nothing, obviously, just started the company. And then what do we have? Total motorbikes are what? 150,000, right? Sorry about that. Okay, let's just fix that. It was 150,000. And that 150,000 is due to what? You paid for it via bank. So we go to bank and say we link this in here. Then that was due to bank, and then we leave it like that. Then from there, we're done with our transaction regarding motorbikes here. And then from the, since we're already talking about motorbikes, we go and do what? We go and complete also this transaction over here that we've actually paid for motorbikes over here. Motorbikes, for how much did we pay for motorbikes? 150,000. Then we are done over there. After that, these motorbikes have depreciation. So now let's just go and account for depreciation while we can still remember. So we just say depreciation, P&L, SPL, P&L, and then this is an expense, has a debit side. So now we have what? This is first two motorbikes that we had. We had our first two motorbikes that we had, which were what? The total cost of them, it's 100,000. Now this 100,000 is going to be what? Divided over what? 5 years, right? So this is the total cost of depreciation for the two motorbikes. Then the other motorbike that we had what? Depreciation also as well, but we only use it for half the year. So it means we only use it for 6 months since it was purchased halfway through the year. So now we're gonna go and say fine. We have our motorbike over here. And then we're gonna have to first do this. Open the bracket. Say it was 50,000 the purchase cost of this motorbike, and then divide that by what? By 5 years. And then after dividing it by 5 years, and then we multiply it by what? For 6 months that we used it over the 12 months that we actually used it for. And then from that particular point in time, then we can say accumulated depreciation motorbikes. We'll just say abbreviated to this. And remember, this is a what? This is a negative asset that we have in the company, and it has a balance on the what? On the credit side. So then we go and say accumulated motorbikes. This is goes into the SFP since it's an asset. And also, just to make your life simple, incomes and expenses SPL, assets and liabilities SFP, owner's equity SCE. You are done. If you can just remember that in your head, then you are done. You're sorted, right? And then now this is going to be what? The sum of the two on the left of the both these depreciations. And then at this point in time, what do? You go and say, okay, fine. You want to go and create the what? The depreciation journal. Depreciation journal, it means over when we get into here, we had what? 20,000 and 5,000, right? So now let's just go and put that in there. Had that 20,000 and that 5,000 over here. And this was all due to what? We were accumulating what? Accumulating depreciation. So we're going to credit accumulated depreciation, DPN, and then leave that like that. Accumulated depreciation motorbikes. Then leave that like that. And then also at the very same time, while we're doing this, we go on the side and go and create what? Go and create the ledger for what? Accumulated depreciation as well. So now we go and say accumulated depreciation ledger for motorbikes. Write that in there, and we say we had what? 25,000 that actually occurred on the credit side. So now it's going to be 25,000 over here. 25,000 due to what? Due to depreciation, right? And then we are done with that ledger. And then from there onwards, what do? We are done the vehicles, the motorbikes, I mean. And then now we see that the owner took 10,000 for personal use. Then what is this? When the owner is taking money from the company, remember, we're gonna debit the drawings, but it is not an expense. It is part of owner's equity, whereby the owner is reducing the equity of the company and taking back some of their shareholders' contributions. So now always remember that. So this is going to be drawings, then statement of changes in equity. Then you put that in there. Then this was for what? 10,000. And then all of this was taken from the bank account of the company, SFP. Put that in there. Then we close this off, right? And then now what do? We go and say on our drawings, you can go and create the drawings ledger account here. Drawings ledger account, and create that. Drawings drawings ledger account, we have to go and what? Debit the drawings ledger account due to bank. So now we're gonna say here due to bank, due to bank, and then how much was that for? It was for 10,000. Then immediately once you've done this, we go into the ledger account of bank. We say you have to go and credit bank due to drawings. Drawings for what? For how much? For 10,000 also as well. We're crediting that, and then we are done with the transaction. Then afterwards, what do we do? The monthly rent is 3,000 per month. So now you have to pay rent for the whole year. We just at this stage, in this state, you're just making assumptions which we paid rent for the whole year. There was nothing accrued, none. We'll do the accruals and stuff like that, prepaid expenses, income received in advance. Once you start doing that, just the trial balance. For now, we'll just focus on this. Then now, what do we have? Rental expense. Rental expense, we debit that. Rental expense goes to SPL. SPL. Go in there and say you are paying what? 3,000 every month for how many months? For 12 months. Then from there, what do? We just assume that we paid with bank. Just as make an assumption that we paid with bank, which is gonna be our SFP over here. Then just use that over here. Then immediately you go into what? We open what? Rental expense ledger. Then we say rental expense. Then on that ledger, on that rental expense ledger, you're going to go and debit the rental expense ledger by bank. Bank for how much? For 36,000. And then, okay, let's leave it like that since we haven't closed off yet. Then from there, what are we going to do? We go and look at the other transactions. Or before the other transaction, we go to our bank account and say we had rental expense, bank ledger, rental expense. For how much? For that 36,000 over here, right? Then you complete with that, and then afterwards you go and say you completed 544 deliveries for the year with an average revenue of 100 rands per delivery with 60 rand fuel cost on average also as well. So now what do we do at this point in time? We go and say okay, fine. So we incurred actually sales over here. At sales, with our sales go into where? The SPL. It goes that in. Then we had how many sales? 544 sales with the revenue of what? An average revenue of 100, right? Then you put that in there. Then you see sales. Then now also you have to remember sales on the thingy, what you call it, on the credit side. Since there is income increases on the credit side, and then it means that we actually received money on our bank account. Since we are assuming that there was nothing that was actually sold on credit or delivered that was made on credit. Then we say SFP. Then we go in there. And then now at the very same time, since we had an average fuel cost of 60 rand per fuel, so now this is where you need to always understand the type of business that you are operating with. We are running a what? A deliveries company, and you had fuel cost of 60 rand. So now at this point in time, while we are doing cost of sales, right, which is gonna go into the SPL, you have to remember that with the cost of sales, let me just input the amount. We had 60 rand cost, so it was 544 multiplied by 60 rand per transaction, right? I want you to know, remember that now on the credit, we are not gonna credit inventory for the cost of sales. The fact that we do not have any fuel tank, the fuel tank it's the one that's on the vehicle only. We do not have any fuel reservoir or anything like that. Since we do not have that, it means since the business is still new, also we have not purchased a reservoir tank to actually store our fuel in, so that we can actually have inventory of fuel. So it means at this point in time, we're actually gonna credit what? Our bank. You understand? Bank SFP, credit our bank over here, and then we are done with that transaction. But had we had a fuel reservoir tank for the company, then we would have had to actually credit what inventory over here. You understand? So that's what you also need to take into account. And then from here, let's go and say and adjust for this these transactions over here on the ledgers. Then we go and create ledgers also again for sales. Just copy the format. Then you say sales. And then you have to go and do what credit sales due to what due to bank due to the money we received in the bank. Then you say sales credit 54,400, and then you go to the bank ledger again for that 54,600 nanani, and then you go and say sales due to what that 54,000, right? And then you put that in there, and then also at the very same time you prepare our cost of sales. And prepare our cost of sales. Okay. Cost of sales. Okay, that's fine. We just make that in capital letters. Then with the cost of sales, you have to go and say, fine, we're gonna debit cost of sales due to 2,640. There's 2,640, and then we're gonna insert what bank over here, bank, and then you go to the bank ledger also again, and say you're gonna go and credit cost of sales, with what with that particular amount, this 36,000 what. But I like it if ever you just draw it from the ledger directly, from the journal directly, instead of pulling it up from the ledger, from the other ledger and stuff like that, right? And then from this point in time, what other transaction do we have left? There's no other transaction that is actually left for the year, right? Then now we can actually start our closing off process. It's gonna be lengthy, but we can finish it fast, right? Then now with our closing off process, what we're gonna say, we're gonna have to look at the debit side and the credit side and compare the two, whichever side is the biggest. So now we're gonna say sum out of this above. How much is that? And then we're gonna go and say sum out of this over here. And then you get this also as well. So we see that the debit side is bigger than the credit side. So means we'll go with the debit side and say now our closing balance. This is the closing off process over here. Closing balance. Carry down. It's gonna be what? It's gonna be this amount down here minus the sum of everything that's above. And then we have a closing balance of 8,260. Then that is going to be our opening balance carried down for the next year. Then we have that. And then when you go into loan repayment also again, we're gonna say you had an opening balance of 0, and then the capital portion of the loan that we are paying this year is here. The one that we're going to pay next year, it's here. Then now this one also, it's the red one. It's part of the capital portion that we're actually paying for this year, which we are paying with bank. And then now you're gonna go and say, obviously, we're gonna sum this side, sum of everything here, and then it's gonna be equal to this. And then now see our closing balance to balance everything off. Closing balance carried down. We have what? This minus this. Then have 12,500, which is gonna be our opening balance for the new year, next year. Opening balance carried down. Then you go and put in what? 12,500 over there. And then we had our startup cost. Startup costs are an expense. So now we have to say, since they're an expense, it means they have no closing balance. So now we need to close this off to a certain area, which in this situation will close it off to what? Profit and loss. Closing this off to profit and loss. Then you go and do that. We've got the 5,000 over here. And then also motorbikes, we look at motorbikes. Motorbikes are an asset, goes into SFP, so it must have a closing balance as it had an opening. Then we go and say, okay, fine. Here, the side is equal to this. The side will be Now to equate this into this and say closing balance, carried down, and then put in that 150,000. Then the opening balance for next year is going to be that 150,000 over there. And then you're done. You're closing off the accounts. Now depreciation is part of the P&L. It's an expense. So now we're going to say it does not have a closing balance. So we need to close it off to somewhere else, which is going to be profit and loss. Then you're going to go and say, find this equating to the sum of these two. Equating to the sum of these two. And say that 25,000 over here. And say profit and loss. And then go in there. Put the 25,000 rental expense. It's an expense, same thing, same procedure again. Just gonna put this in here, and then you go and put this in here, and goes it off to what? Profit and loss. Profit and loss. Then we are done with that, and then sales is income and expenses also as well. We're gonna close it off to profit and loss. And we go in here, put this in here, put this here, and put this in there. Then go and see this over here. Then put what? Profit and loss also as well. Profit and loss. You understand? Then from this point onwards, now let's go off those shoulders contributions. And there's another thing that we actually forgot to do now that I'm realizing this. We actually haven't forgotten it. Now, I want you guys to take note of where's the drawings account. There we go. Now, since we want to close the shareholders contribution, we want to see what else actually affected shareholders contribution. It's the drawings over here. So now on the drawings account, you're gonna have to go and close the drawings account also as well. And drawings account do not have a closing balance. So since they do not have a closing balance, we're gonna close this to what? Shareholders contribution. So we're closing the drawings account into what? Shareholders contribution, right? And then you're gonna say that 10,000, and then immediately after this you go over here and say here you're gonna be having a debit of what? For drawings of how much? Of 10,000. You understand? Before it goes off the shareholders contribution account. Then from here, that's when you can actually close the drawings account. The shareholders contribution account, because you've already closed the drawings account. And then you can go and see shareholders. Oh, sorry about that. Actually, I see on the bigger side, it's this side, obviously. It's evident. And then put that in here. Then the closing balance carried down will be what? Will be this 100,000 minus this 10,000, which is 90,000. Then the opening balance for next year carried down will be what? That 90,000 over there. Then you're done, right? And then from this point onwards, what do we have? We have the loan capital, which was 100,000 at the beginning of the year, and then this portion, the one which you transferred to current liabilities on the loan repayment, was for this year, the loan you're going to pay this year. And by the end of the year, we said, okay, even in the next 12 months, you're going to pay another 12,500. So let's remove it and move it from the non-current liabilities to the current liabilities. And then let me just make it red also as well. Like its cousins over there. And then now we're gonna have to go and say we want our closing balance, which is evident. This is the bigger side. And then it close this off and say okay, fine, closing balance carried down. Then go and say okay, fine, 100,000 minus the sum of the above, and then it gives us 75,000 for our closing balance. Then this is going to be our opening balance carried down for the new year, right? Then you have 75,000 over there. Then at the accumulated depreciation, also again, it was for what I ended up being 25,000 for the year. Accumulated depreciation, you have to remember, it's an asset, a negative asset. Even though I forgot to include the opening balance over there, it's fine. we can continue regardless and say since there was no opening balance, can just say here, then put in the closing balance carried down, and this closing balance carried down is going to be this 25,000, and the accumulated depreciation opening balance carried down for next year is going to be what, that 25,000 over there. Then our drones account is already closed off, and then the cost of sales account, since it's part of the P&L situation, we do not go, we close it off to what you call the profit and loss statement, loss ledger, then profit and loss ledger, go and say here. Then now, since we've closed off things to the profit and loss ledger, now we need to go and create the profit and loss ledger. You understand? So now you have the profit and loss ledger over here, which is going to be happening. Now we need to make adjustments to the profit and loss ledger. You understand? Then you go and say you have this profit and loss ledger, and then now we go and look for which ledgers are part of the are closed off to the profit and loss. Then you go and say bank, that's SFP, loan repayment, that's SFP, startup cost, that's an expense, we closed it off to profit and loss. So now we need to go and say debit startup cost for how much, for this particular 5,000. Then we are done with the transaction. And then motorbikes, that is an SFP transaction depreciation, that is part of the profit and loss. So now we go and say depreciation, and then for how much, the depreciation for 25,000, right? Then now we go to rental expense. Again, rental expense will have to be debited on this thing for how much, for this 36,000 over here. Then sales also, again, they have to be what, in this situation, sales, they are on the credit side, so now we have to debit them. So now we're gonna say sales, credit sales for how much, 54,500, right? Then we are done with that. And then we look over the side, shareholders contribution, that's SCE, loan capital, that's SFP, accumulated depreciation, that's SFP, drawings, that's SCE, cost of sales. Then you come back in again and say fine, you had what you call cost of sales, right? Cost of sales over here. And then with the cost of sales, what did we have? 32,640, right? And then we close that off. Then now we're gonna have to go and say, okay, fine, we've done everything that we could. Now let's close off the year, right? When we close off the year, you can already see this side is actually much more bigger than the credit side. So now let's just go and say sum everything up. Now I'm gonna go and sum everything up over here. Say this with this, and then now I'm gonna go and say after we make the profit or loss for the year, we transfer it to retained earnings. Or in this situation, since it is a loss due to it going to the credit side, so now you can say it accumulated. You can also use accumulated loss. You understand? And then you go and say that is gonna be what equals to this minus this. So this is the loss that the company actually made for the year. And then you can like, okay, fine. Now we go to our thing, our retained earnings account. Retained earnings account. Now you go to our retained earnings account and say fine, we had retained earnings over here. Then on the retained earnings that we have, what else do we do with our retained earnings? Retained earnings have a opening balance on the credit side, and remember with opening balance carried down, balance carried down, and at the inception of the year we had nothing at the beginning of the year. But now what did we have? We had our profit and loss, which actually occurred over here, which is in this situation a loss, since it's going where, on the debit side of retained earnings, right? So now I'm gonna go and put in that 44,240 and then equate both sides, and then that in there. Then say we have what? Closing balance. Also, this will teach you how you guys should always know, but even if there's an opening this side, the closing can be this side, especially for retained earnings and bank. Those things can change sides, you understand? So be very careful of those two. So closing balance carried down. Then now we're gonna have what? This particular amount down here. But our opening will be on the debit side. Opening balance carried down will be on the what? On the debit side. Understand? Because it's a loss. But if it was profit, we'll be having an opening balance on the credit side. Understand? So I think for now, because you guys sometimes have a short attention span, that will be it for today. And that's how you actually close off your accounts and stuff like that. You do your journals and your ledgers, that's how you do them. And then next time on the next video, we shall be focusing on the trial balance, and then from there we go and prepare the statements of thingy, what you call financial position. But I will do the SPL and SFP and SCE together, and then the statement of cash flows, that one I will not do a video for you now. Okay, I will do a video for you guys, but I will separate it from the one of the SPL, SFP, and SCE due to one particular reason. Is that SPL, SFP, and SCE, they are all prepared using the accrual basis of accounting, which is part of the IFRS principle, right? But now we want to measure the cash that is actually flowing in and out of the company, which means we have to go and prepare the statement of cash flows in the cash basis of accounting, not the accrual. So now what does this mean is that whenever we're doing the statement of cash flows, we'll have to start with our profit and loss for the year. And then afterwards, remove all the transactions that are accruals, that are prepaid, that are add in the accounts, transactions of income received in advance. Actually, even prepaid expenses, we have to think, okay, we remove that. In income received in advance, we add that back in and stuff like that. So now the transactions that we actually on that are accruals and stuff like that, we have to reverse them and make sure we counter for the transaction that were only cash only. And then afterwards, even also we have to remove things like the profit and loss from non-current assets and stuff like that. So for you guys, that will be another whole situation. So for now, for you to keep you guys not confused, I'll just keep it simple and separate the statements into these three: SPL, SFP, and SCE, and then SCF. I'll just do it separately on its own. You understand? And then yeah, that will be it for me from my side, guys. I hope you learned everything that you needed to learn regarding lectures and journals. You should be good by now. And then if you have any questions, do post them under the comment section below. And that's it for me. That's Katie Machola signing out. Danko.